Hello, everyone. Thanks for joining our webinar. Glad to have you here. As we got a lot of interest for investors at different stages in the education process, on their investing journey, we've gone ahead and pre-recorded this webinar so everybody can watch it in their own time, pause it, take notes. Guys who've maybe find some things too simple can fast forward, so everybody can kind of move at their own pace and learn how to analyze balance sheets, which is, I think, absolutely crucial, especially right now when a lot of uncertainty regarding the coronavirus, a lot of businesses suffering. I think that's where the strength of the balance sheet really becomes extra important, because that's basically, it shows how much the company actually owes versus against how much it owes to other people. So we want to make sure that it's at a safe level where the company can manage that level and can keep operating even through difficult times. So just a quick disclaimer before we start off. I may hold positions in companies mentioned in this webinar, and this is not a recommendation to buy or sell any shares. You can lose a part of your invested capital. I'm not responsible for the accuracy of any of the figures presented in the article. I'm not a financial professional of any kind. Any stock transactions or analysis published should not be considered to be investing recommendations. Before making any investing or financial decisions, contact an appropriate professional. This webinar should be viewed for entertainment purposes only. So let's get started. I think a lot of you, when you start out on your investing journey and you look at all the ratios and 10 years out there, and it can kind of seem like this, it's so many complicated calculations, so many words you've never seen before, a lot of accounting terms, investing terms. Whilst they all have a kind of a purpose, it's a lot of times it's overly complicated. You don't need to know all of this. You don't need to have an amazing IQ, or you don't need to have a finance or accounting background. It's just, in the end of the day, we're analyzing the businesses that are underneath the stocks. You buy a stock, you buy ownership in the business. So what we need to see is how the businesses operate, how they make money, and how much. In this video especially, we're going to look at how much they owe on their balance sheet versus how much they make and how much they actually own in the business. So don't be discouraged if you start off and all the investing jargon kind of seems so complicated to you that you just leave it and move on. So when you signed up to the newsletter, I sent you the list that I personally use. It's got 13 ratios on it. It's different categories, balance sheet, valuation, profitability, and the dividend. And today we're going to be looking at the balance sheet. And for the balance sheet analysis, I use 3 ratios. I use the debt to equity, debt to EBITDA, and the interest coverage. So the debt to equity, I'd like to see ideally under 0.5, debt to EBITDA under 3, and the interest coverage more than 8 times over. So I said on the last slide that 2 slides ago, that don't get discouraged by the investing jargon, and I'm throwing EBITDA at you straight away. So stay with me here. We're going to get through it, and we're going to explain it in easy terms. So debt to equity, starting off with the first one. I think it's probably one of the most used ones. So you want to see essentially how much debt does the company have in relation to the equity. So how much it actually owes. So I think most people have heard equity used a lot of times in relation to a house. So we're going to look at through in the house example. And the checklist criteria that I want to see this ratio under 0.5. So we're going to have a look at debt to equity using an example of a house. So this is a $1 million house. So it's a $1 million asset. And if you go ahead and put what normally people do, you put 20% down. So you put 200K down payment, you take on 800K. So 80% in loan, you have 20% equity in this house and 80% debt. So what you own in this house is 20%, and the rest of it is funded by debt. If you want to take the debt to equity ratio in this house, the debt is 800. We divide it by the equity, which is 200, and we get a debt to equity ratio of 4. So as we want to get debt to equity in our businesses under 0.5, this is obviously not looking great. I wouldn't of course, every business is a little bit different, but normally such a high debt to equity ratio would be a red flag. And we're going to have a look at another house example to see if we can, what it would represent to have a lower debt to equity ratio in a house. So let's say this is a 300K asset, 300K house. So we put the same 200K down, take 100K loan. So we have actually twice as much equity in this house as we do debt. So we can run our debt to equity calculation here, and this comes out at 0.5. So we want to see it at under 0.5, but 0.5 is fine for me as well. So it checks out. So using a house example, I think this gives us a pretty clear overview of what equity is. So if you take a bank loan, the bank funds that part of your purchase. So until you pay that back, the house is not 100% yours. If you had to liquidate the house, you wouldn't get all of the, if you had to sell the house, you wouldn't get all of the 300K for it. You sold it for 300K, you would get 200K, and because you would have to pay back the 100K loan. So your equity in this house is 200K. So that's using a house example, which is, I think, easily understandable for most. So now we're going to take an actual sort of a business side approach to it. We're going to look at an imaginary corporation. So we're going to look at Tony's Hot Dog Corporation today. We're going to see if it fits our criteria, our balance sheet criteria for investments. So this is Tony's business. He has one asset. His one asset is the hot dog stand on the wheels. So it's priced at $1,000. So that his only asset is $1,000 hot dog cart, hot dog stand. And he takes a $250 loan from the bank to get his business going. So we want to see what's the debt to equity ratio in Tony's hot dog corporation. So we know the debt is 250, so we need to find the equity. So equity is assets minus liabilities. So if he would sell his hot dog cart and he would pay back all his debts, what he would have left. So we take the value of the hot dog stand, take the debt off it, and we get to a figure of $750. So that's the equity in Tony's business. So if you want to get the hot debt to equity here, we divide the debt, which is 250, by the equity, which we just found, which is 750, and we get a ratio of 0.33, which is below our checklist criteria of 0.5. So that all checks out here. From the debt to equity standpoint, I'm liking Tony's business so far. So we're going to use a real life example of a real business. So we're going to use Cisco. This is actually a business I own in my dividend portfolio and has a strong balance sheet. So we're going to look at 2019 figures. So that's Cisco's total assets in the end of 2019. On the balance sheet, when you read it on a financial statement, usually all the figures are given. If you look at the fine print, it says all the figures are given in millions. So that's the figure in millions. And on the balance sheet, we can find the total assets. We can find the total liabilities, which is this figure. So if you want to see how much equity is in Cisco, we take total assets, take total liabilities off it, and we get the equity. So we have both the figures for the assets and the liabilities. So we can find the equity using this calculation. Very straightforward. Now this gives us the second part of the debt to equity ratio, but we need to find the debt first. So when we used Tony's Hot Dog Corporation, his debt was the only liability, but so all debt is a liability, but not all liability is a debt, if that makes sense. A company so big such as Cisco, they have other liabilities as well. So we need the liabilities to get the equity ratio, but it's not necessarily all debt. So liabilities might be such as, they have to fund their pension plan. They have to pay some lawsuits. They have to pay for the salaries that haven't yet paid out, the income tax that haven't yet paid out. So this is everything. Liability is everything that they must pay, but they're not all debts, if that makes sense. We want to find the debt to equity ratio to see how much debt the company has in comparison to equity. We don't want to find out the actual all liabilities to equity. We want to get the debt to equity ratio. If that makes sense. So we have the equity and we need to find what's the debt, because like we said, debt doesn't equal liabilities. It's slightly different things. Debt is a part of liabilities. So we go and find Cisco's long-term debt, which is this figure, again in millions, because on the balance sheet you will see that things are given in millions, most likely on most large cap stocks. So we have the debt, we took it off the balance sheet, this is long-term debt, and we have the equity, which was all the assets minus all the liabilities. So now we can run the debt to equity calculation for Cisco. We run it, we get to a figure of 0.32. So as you remember, our checklist criteria was under 0.5. So that all checks out. Like Tony's hot dog business looked good from a debt to equity standpoint. For me, Cisco looks very good as well. You know, this is obviously, you would say, there's two completely different businesses, but a business is a business, and you can use the ratios to find out what's happening actually in the business. You know, I think is the most important skill to have, to be able to analyze businesses, not just to look at the stock price and make your decisions based off that. So that takes us to our next ratio, which is debt to EBITDA. Now you might start having some questions. Okay, we're at EBITDA, so what does that mean? We know that the checklist criteria is we want this ratio to be under 3. So we want the debt to not be more than 3 times our EBITDA. So we use Tony's Hot Dog Corporation again, just to give a really, really easy, really simple explanation. Tony's Hot Dog Corporation, we know his stand, his $1,000 asset is here. He's selling hot dogs. We know his debt. So that gives us the first part of the equation. We know his debt was $250, as we've seen previously. And EBITDA, let's say, is $100. You might say, what's EBITDA? Now you've lost me here. Well, EBITDA stands for earnings before interest, tax, depreciation, and amortization. So don't get discouraged by this. It's not as complicated as it seems. So EBITDA is basically earnings. So $100 in EBITDA is, let's say, Tony's yearly earnings before he pays any interest on his debt, before he pays the tax, and before the depreciation and amortizations are accounted for. So we have the EBITDA here. So if you want to get net earnings, we take down the interest. So this is EBITDA is earnings before interest. So we know that Tony had $250 loan from the bank. Let's say he has a 4% interest rate. So his yearly interest payment is $10. Okay, so we take $100 EBITDA, take the $10 interest payment off it. Let's say he pays a 20% tax rate on his earnings. So he pays $20 in tax. And let's say depreciation and amortization amounts for $5. So we get to net earnings of $65. Now, depreciation and amortization, I wouldn't get too much into it right now, because you don't really need to know all that much about it in this example. It's basically the way the erosion of value in a company's asset is recorded in accounting terms. So basically, you've heard, like, let's say, if you drive a new car off the lot, it already depreciates by 20%, which means that if you want to sell the car now, you would get 20% less for it. Well, in accounting, you have to record that somewhere in your accounting, in the business's accounting. So let's say Tony's hot dog cart gets a few scratches here and there if he bumps into some corners or whatever, or some walls. So it wouldn't be worth $1,000 anymore next year. If you wanted to sell it, it would be worth, let's say, $995, because it's a little bit worn out. So, well, he has to kind of record that somewhere, that his asset is now worth a little bit less. Well, depreciation and amortization, it's a few techniques companies use the way to record that. It's also built into some tax things as well. But I wouldn't get too much into it right now. Just know that it's a way of recording the sort of the way that assets are worth less and less over time. As you know, your car is worth less and less over time. or Tony's hot dog cart is worth less and less as it gets older and more worn out. It has to be accorded somewhere. Anyway, we are on debt to EBITDA here. So we know the debt, which is $250, and we know the EBITDA, which is $100. So we can get the debt to EBITDA ratio using those figures. So we divide the debt by EBITDA and we get a figure of 2.5. As our checklist criteria is under 3, so this checks out. Now debt to EBITDA, I use it to see basically how many years it would take the company to pay off its debt if it just directed all of its earnings to paying down that debt. So Tony's yearly earnings, basically, if it put 2.5 years worth of earnings into it, he could pay off all of its debt and the company would be debt free. So it's important here to know the moving parts, because if I just give you, just use a debt to EBITDA under 3 and you not understand it and start to use it, okay, you would think you would still mostly avoid a lot of the highly indebted companies, but it's important to see what goes into it. The debt is 250, the EBITDA is 100, but let's say the EBITDA goes up, Tony starts to make more and more money, then the debt would look smaller in comparison and the debt to EBITDA would look much better, even though the debt remained the same, just that because as he's making more and more money, the debt level compared to his earnings looks much better. But on the other way, he can also, if his earnings start to go down, the debt is the same, but as the earnings get smaller, his debt load looks more and more risky. Now, mostly you see if the EBITDA would go up and up and up, Tony could take on more debt for future growth of his business. He could take on more debt to buy another hot dog stand and employ somebody. If his EBITDA keeps growing up, he can take on more debt, but still keep his debt to EBITDA ratio at a manageable level. So it's important to know both sides to see how they can affect this ratio. Now let's take also Cisco's example again, since it's a good example to use as a strong balance sheet. So this was Cisco's EBITDA in 2019. It's a large company, pays a good dividend, and has a very strong balance sheet. Should give a disclaimer here again that I own shares in Cisco. But so we have the 2019 EBITDA, and we take their debt. So actually we use the long-term debt here. They have a small amount of short-term debt as well. But just to keep it really simple, that you don't need to take many figures off the balance sheet, we're going to use the long-term debt only. I think it might be short-term debt is a small part of it, but we use it for simplicity. We take the long-term debt. So we know the debt level of Cisco. We know the EBITDA they made in 2019, so we can get that debt to EBITDA ratio here. And it comes out to 0.9. So as our checklist criteria was below 3, it checks out very well here. Now, if you get a 0.9, also a very, very low figure, you don't see that much often. That means that Cisco could actually pay off all of its debt in less than a year, basically, if they chose to do so. Now, obviously, there's no reason for them to do that if they feel that they can use this debt to fund projects that they are profitable with them and so on. It's a very manageable debt load, so anytime they run into trouble, they have absolutely no problems in maintaining that. Which takes us to our last ratio that we use to analyze balance sheets. So that's the interest coverage. So in our checklist criteria, you can see that we want interest payments to be covered more than 8 times over. Now, what does that mean? So this ratio, I think it's a very quick way to measure how easy it is for the company to pay the interest on its debt. So we take Tony's hot dog corporation again to see how his balance sheet is looking. He checked out on debt to equity levels. He checked out well on debt to EBITDA. Now we're going to have a look at interest coverage. So Tony again in his chart. So we want to find the interest coverage, which is EBIT divided by interest payments. So this earnings EBITDA, as we know, was $100. That was earnings before interest, tax, depreciation, and amortization. So EBIT is earnings before interest and tax. So depreciation and amortization is accounted for, but before interest and tax payments. So we take the $5 depreciation and amortization. charge. So that means Tony's accountant is recording that Tony's hot dog stand is a little bit worn out. It's not worth as much. So in EBIT, we get $95 of EBIT. So that's earnings before interest and tax. And of that money, we want to see how many times over could he pay his interest payments. So as we learned from before, his interest payment was $10 and his tax was $20. So if you want to get the net earnings figures from that, we can find that it's all the same. And we know that his loan was $250 from the bank at 4% interest rate. So yearly he pays $10 in interest payments. So we can take the EBIT, which was $95, and divide it by the interest payment, which is $10, to see how many times over could he pay the interest payments from the EBIT. So we divide 95 into 10, we get 9.5. So as you remember our checklist criteria, we want to see this higher than 8. We want to see that EBIT covers interest payments at least 8 times over. So it's over 8, it checks out, you know, Tony's hot dog business balance sheet looks solid. Obviously, it all, as we mentioned before, it all really depends on his earnings. If his EBITDA, his EBIT, everything keeps going up, but the debt level stays the same, it looks even safer. But he will most likely, if his earnings go up, he might even want to take on more debt because he can grow his business and it will still look safe. Then on the flip side, if the earnings start going down, the interest payments look much harder to service. So the debt is harder to service. So again, important to know what goes into it, you know, in this ratio. We want to see earnings go up or at least, you know, above inflation. That's our topic for another webinar, but we want to see how many times over can he pay the interest payments from his EBIT, so which is earnings before interest and tax payments. Now, let's look at another real life example. Take Cisco again, because we've been using it throughout this webinar. So we want to, in order to make this calculation, we want to find the EBIT and we want to find the interest payments so we can make the calculations. So we knew the EBITDA, which was this figure, and then after amounting for the amortization and depreciation, the EBIT was this figure. So again, everything in millions, as it is usually in these reports. And we just looked at 2019 figures for this, and the interest that Cisco paid on its debt is in 2019 was $751 million. So if we take the EBIT and divide it by interest payments, we find out that Cisco can pay all its interest payments almost 19 times over from its earnings before interest and tax payments. So that's obviously, the debt is very safely manageable because we want this to be over 8, but this is way higher than that, which shows again that it checks out and it's as a strong balance sheet. Now, if you have any questions, which I'm sure you do, I hope I made it easy to understand for everybody, you know, trying to explain it using sort of a very simple explanation of Tony's Hot Dog Corporation, which is a made-up corporation, but where we used smaller figures to make it understandable what goes into the balance sheet, what goes into the ratios. So if you have any questions, you can write me an email at contact@dividendathlete.com or catch me on Instagram at dividendathlete. So you can write to me at any time. I try to answer to all of you. Obviously, I'm really appreciative of everybody who's part of our newsletter. You know, it's growing rapidly. You know, also you can find us on our blog at dividendathlete.com, which you know has seen really quick growth as well. You know, I wouldn't have expected for it to hit off this quick. We're gonna actually start putting some more content on there that will help you with calculations as such. You know, we're gonna put something on there that's gonna help you give an estimate of how much you can earn in dividend income based on your age, based on how much money you're investing, how long is your investment time horizon, and so on. So I'm going to be excited to share that with you guys. So I think it's important to have you cannot get an exact estimate because future is always a little bit uncertain, especially in investing, but it will give you an overview of how you can how much you can expect, based on how much you put in when it comes to dividend investing. Thank you very much for attending. I hope you got value from it. And like I said, if you have any sort of questions, don't hesitate to get in touch with me. Really, I always like to talk investing, and share my journey as I'm going towards my investing goals and educating everybody else in the process as well. So thanks a lot for your time, and I hope you got value from it. And again, if you got any questions at all, just shoot me an email or write to me on Instagram. Take care and wish you successful investing.